Hello and welcome to this special edition of Profit Insights. I am Hiral Dadia and today we are discussing all about multi-baggers. Joining us on the show to discuss more is Chakri Lokapriya, MD at TCG Asset Management. Welcome to the show, Chakri.
Hello, good afternoon.
Good afternoon. Chakri, my first question coming to you is overall, we've been talking about what multi-baggers have been. We've been identifying so many of them. One of the multi-baggers that we've already identified from Nifty 50 so far is Tata Motors, something that not really everyone had expected. And that's what everyone is looking at going ahead. For the benefit of the viewers, how are you looking at multi-baggers and what is a multi-bagger according to you?
It's a good question because multi-baggers come in different types and shapes and sizes. In terms of, it can be a growth company, a company who's adding new products and therefore growing very fast. Or it can be a turnaround, a company whose fortunes have dimmed, but now its valuations are so low. Now the business is turning for the company. It's beginning to do better and therefore will start making greater amount of revenue or profits. That's the second kind. The third kind could be, a company which has been growing at a steady state, but now suddenly new avenues of businesses have opened because of a change in the business landscape. So they can belong to any one of the categories.
Right. So clearly, returns more than the index over the last 3 to 5 years is something that we're looking at in terms of multi-baggers. Now, when you talk about identifying multi-baggers, you did mention a couple of criterias. Let's first talk about a company which is a growth company, which can be a multi-bagger, right? Firstly, what is it that you would consider as a growth company? And if you could help us with a couple of examples for the same.
Sure. Now let's take the example of, they come in different sectors. So let's take for a very boring sector like consumer staples. Now, within that, you take a company, Varun Beverages. They are one of the largest franchisees, distributors, bottlers of Pepsi. Now, so they bottle Pepsi, Mirinda, Mountain Dew, and they also various juices like Tropicana and also Aquafina. Now, this company has been a market leader, one of the largest franchisees of Pepsi. So as Pepsi grows, the company grows. And this company, Varun Beverages in particular, has gone up something 3.5 times in the last 2 years. One of the main reasons for that is one, it's executed really well. And second, its revenue is growing much faster than that of the sector averages because it's expanding into new markets. It's expanded into new countries. It's expanded into countries like Sri Lanka, Morocco, various other countries that it's getting into. Now, as these revenue opportunities unfold and the company executes well, then you begin to ascribe a multiple to the company based on its execution in the past, as well as its future revenue potential. So here's a very good example of a company as a staple, Varun Beverages, but has gone up 3.5 times in the less than about 2.5 years.
Right. So that's with regards to where a growth company is concerned. We're talking about Varun Beverages. Now, second category that you have identified so far is a company which probably is seeing a turnaround. What is that kind of turnaround that you would watch out for, number one? I'm sure it'll be various depending on various sectors. And any examples on that you can give us?
Now, turnarounds can be manifold. It can be a company, whose its own business problems, therefore the stock has fallen. Or second, it can be because of the sector. Now, let's be more specific. Let's take, like, for example, an REC and Power Finance. REC Limited, the stock is up about nearly 5 times over the last 2 to 3 years. Power Finance is up about 4 times. Now, this company, they are Navratna companies, they're government-owned companies, power utilities, they finance power utilities. Now, if you rewind back in the past to let's say around 2007 and 8, they had financed a number of power companies. Supreme Court had come and changed some regulations, canceled coal mines. So a number of power utilities went bankrupt and they all became NPAs for Power Finance and REC. Now, you fast forward many years later, the company's cleaned up its balance sheet. balance sheets are stronger in ability to grow. And then now renewable energy has become a very big thing and is continued to going to be very big for the next many years. Now, being the lead financiers of this in power financing, both the companies, REC and Power Finance, are growing very fast. The balance sheets are strong. The secular growth is visible over the next many years. Even though the stock is up, both of them are up about 4 to 5 times in the last 2 to 3 years, the valuations are still undemanding and the margins of the business are going to improve. So this stock would continue to do well. So that's another sign of an example of a turnaround which has become a multi-bagger.
Right. So REC and PFC, these are examples with regards to where a turnaround company goes. Now, overall, if you see in terms of both of these companies as well, what is that key factor that you're considering which could continue to be a growth driver from here on? Because as you mentioned about the past as well, where a lot of negatives were there, present, there is a new thrust to renewables, thermal energy as well. So from here on, between the two of them as well, which is the one that you are preferring?
Good question. If you look at both the companies, they are NBFCs and they finance power utilities as well as infrastructure companies. Now, that is the government's growth intent to expand. And in terms of renewables, it's not just India, but all over the world, renewables has become a very important source of growth in replacing and adding on to thermal energy. So both Power Finance and REC are financing. Their loan growth is very strong at about 20% plus for the next many years to come because they cleaned up their balance sheets. Now they're well capitalized as a company to finance that growth. And three, being now in a sunrise sector again, they're able to, and given their size, so that's an important factor where given their size, they're able to source capital at an advantageous rate versus other companies in the financing space. And as a result, they earn higher margins. And that is supposed to continue for the next many years. And lastly, from a stock perspective, even though they have done well, given that their valuations are still reasonable, one can continue to invest in such companies in Power Finance REC and expect a further very multi-bagger return for the next 2 to 3 years.
Right. So that's with regards to where turnaround companies go. Stay with us, Chakri. We'll quickly slip into a short break and come back with another criteria with regards to where identifying multi-baggers is concerned, and that is with regards to change in business dynamics. We'll slip into a short break and be right back. Please stay tuned to NDTV Profit. Welcome back. You're watching Profit Insights. I'm Hiral Datia, and this is a special edition where we're talking about multi-baggers with Chakri Lokapriya. Chakri, we've identified two criteria. The third one that we're looking at is the change in business dynamics. Now, if you talk about the change in business dynamics as well, what is it that you would be watching out for with an example once again?
Okay, this is a very interesting one because now let's take, for example, railway stocks. These are companies which every year in the past you talk about them during the budget, then forget about them. Now, because, they're a simple, boring business, they supply wagons to the railways, who are primarily their main source of customer. And now, if you look at, for example, a company, Titagar Wagons in this industry, this stock has gone up by about 10 times in the last 2 or 3 years. Now, what made the company go up by 10 times? Now, suddenly you had not just the railways just ordering a replacement demand or new demand, but there was this huge government push towards Vande Bharat, faster trains, better trains. And so their order book for new types of trains suddenly expanded, which means suddenly new type of trains means higher margin, a greater size, and longer order book. And second, metros, which did not exist a few years ago. Metros are becoming very big all across the country. And now this company started getting orders to build the wagons for the metros. Again, far more higher specifications than what railway wagons were a few years ago. This again means higher revenue growth rates and higher margins. And third, the company itself has kind of woken up and started exporting its products, railway wagons, to other countries. So that's opened up a brand new revenue stream. So if you add up all these together, now the company is expected to grow in a far higher growth rate than it did before, make far more profit margins than it did before, and therefore the stock, not surprisingly, turned out to be a multi-bagger, up several times.
Right, so that's an example with regards to where Titagar wagon goes and where we are talking about change in business dynamics. Now, taking these three aspects into consideration, Chakri, another question I have is, what are the key risks one should be watching out for? Because yes, as an investor, you would invest, in companies thinking they could be multi-baggers, but I'm sure you have to take into consideration risks which could be common. How would you look at that?
Absolutely right. Now, again, depending upon the criteria that you use to identify one of these companies. Now, if let's say take the railway wagon company. Now, it's going to be its order book, which is worth several thousand crores, which is going to be executed over the next several years. So one needs to keep a track of whether the company is actually converting that order book into actual revenue, and is that revenue adding to the growth and profitability of the company over the years. So you need to monitor it on a quarterly basis and on an annual basis to ensure that this conversion is happening. Now, if you take an REC or Power Finance, you should, one, for instance, look at again its loan growth rate. Is it continuing to accelerate? Are the NPAs of the bank under control? That gives you an indication of whether it's executing well. The executing excellence of a company you can measure. So there are various metrics. So you need to measure the metrics on an ongoing basis, on a quarterly and an annual basis, to ensure milestones are being met and forecasts are being achieved.
Right. So that's with regards to the risks that we should be watching out for as well. How are you looking at, new entrants into the business? How does that factor? How are you factoring that aspect?
That can add a completely new dynamics. If you now a company that did not exist in the space comes up, takes up market share. Now, if you take a company like JSW Paints, Grasim, these are all coming into the paint industry. Now, if you look back a few years ago, hardly 3-4 years ago, Asian Paints was and is the market leader, enjoyed superior profit margins, superior revenue growth, and is considered as one of the marquee players. That was because it was in a 2 to 3 industry. There were Berger Paints, there a couple of other companies, not more, and the competition was limited. Now, once with the entrant of Grasim and JSW, they are in an adjacent business. For instance, they're in the cement business, which has a very similar distribution chain, supply chain, like the paint industry, and therefore they can plug into the paint industry fairly quickly. Now, and they have the muscle, the size to rapidly expand their roll out their paint products. As a result of that, the new entrants kind of benefit. The existing entrants like Asian Paints start losing market share, start losing profit margins, and therefore start paying a lesser multiple. The valuation comes down. So that's a risk for an Asian Paints and a benefit for a newer entrant.
Right, so that's with regards to where newer entrants go. Now, the last and the most important thing that I'm sure viewers and investors are watching out for is that we've spoken about a couple of companies which have already been multi-baggers, right? So from here on, which are the stocks that you would identify as multi-baggers, Chakri? Let's go one by one. Do you think a Power Finance, that's a PFC and REC, in spite of being a multi-bagger in 2023 or even in the last 2 years, continues to see that upside? Because the fundamentals look absolutely strong. I mean, a 10 trillion AUM is what the target is in FY28. The growth we're looking at is about 15% in the next 2 to 3 years. With the exposure that they have, Do you think that's still a multi-bagger, and what's your rationale?
You raise some very important points. And if you just step back from power finance and REC, now renewable energy and thermal energy are going to be very important sources of growth. If India has to grow at 7% plus, you need a lot of power. And in Make in India, which means more of manufacturing, which requires more of power. And therefore, you need greater number of power utility companies. And those power utility companies need financing to start up new factories, and that financing is being led by REC and Power Finance. Now, these companies, like you rightly mentioned, have a 10 trillion kind of target, which is very doable given the current growth rate that they're growing at. And second, the company's management has been very proactive in looking at low cost funds, managing their cost of funds very well, mixing the loan liability ratios. So, which means execution, the company is both of them are continuing to execute really well. And in spite of the fact that they have been multi-baggers, they still trade at only one time book value, about 1.2 times book value on FY26. Now, when your loan growth is clearly evident over the next many years, the companies can be multi-baggers even from current levels.
Right. So that's with regards to PFC as well as REC. Now, any other company that you would identify as a multi-bagger, and why?
If you look at the power space, it's quite a wide space. Now we talked about financiers. We talked about, now if you look at now what is good for somebody can be bad for somebody else. Now, solar panel prices are coming down and coming down very fast. So, and it is like following the principle, which is in the technology industry where prices keep coming down. And therefore, it's bad for solar panel manufacturers. On the other hand, a company like Sterling Wilson, which is an EPC player, which installs these various solar farms all over, they benefit from that because worldwide solar panels is coming down. The company is well positioned as renewable energy gathers pace, not just in India but outside India. The company has exposure to, of course, the Indian market, and outside India they have expanded into various parts of Africa where the solar ability is very strong. In addition to that, now they have a very strong stakeholder in Reliance Industries, owning 40% of the company, and Reliance in itself has very big plans for the solar industry. So given all that, now this is a company which is in turnaround from the past, and given that it has a new leg of growth, the valuations are pretty much on its side, and I think this is another stock which has all the credentials to be a multi-bagger.
Right, so a Sterling and Wilson, which has all the credentials to be a multi-bagger as well. Chakri, let me take one more stock with you. Specifically, if you see in terms of multi-baggers, we've always identified them from the mid-cap, small-cap universe, right? Very rarely you see multi-baggers that evolve out of Nifty 50 or, from the large cap space. One such example that I have with regards to 2023 is a Tata Motors. The year 2023, the stock went up 2 times. In 2021, Tata Motors was up 2.6 times. 2009, it was up 5 times, and 2003 up around 2.3 times, right? So in that last 2 decades, 4 times a Tata Motors has been a multi-bagger. How would you look at this company now?
Absolutely rightly said. And, multi-baggers can come both in large, mid, or small caps. So there is no, I would urge all your viewers to basically to look across the spectrum. Tata Motors, perfect example. This is a company which has, many years ago acquired Jaguar, then Land Rover. In making those acquisitions, it had incurred a huge amount of debt, and therefore the balance sheet became weaker. And then it did lots of steps to lower the debt over time. And meanwhile, Jaguar and Land Rover started doing well. And now the company is foraying very well into domestically and abroad into the electric vehicle space. They have 10 different electric vehicles across the different price point spectrums, appealing to different types of customers. So their future product profile is extremely strong. They cater to both the luxury market, Jaguar, Land Rover, as well as the lower segment. They're there in passenger as well as in commercial vehicles. and they're now generating free cash flows, and their valuations are pretty much on their side. So, with the global economic recovery in sight, with the company actions, looks like Tata Motors again can be a very strong performer in the coming years.
Right. So a Tata Motors that could be a strong performer as well in coming years. In fact, thank you, Chakri, so much for joining us on the show and explaining to our viewers what are multi-baggers, the ways we could identify them as well, and what could be potential multi-baggers going ahead. That's when we're completely out of time on this edition of Profit Insights and a detailed discussion of what multi-baggers could be from here on. Thanks for watching, and lots more lined up on the other side. Please stay tuned to NDTV Profit.